Well, it's a rally of losers because if PSU banks are making a comeback, you don't feel very confident about it. But I guess somewhere the stocks were so oversold that a technical rebound was always around the corner. IFN Holdings is at a 52-week high, and that's largely because markets know that a merger is coming where the businesses would be separated into a couple of entities. And typically ahead of these mergers, stocks they tend to outperform because we've historically seen that the sum of part unlocking of companies in a bull market always creates shareholder value. Gautam Sinha joins us, fund manager with Motilal Oswal Asset Management. Gautam, good to have you back and thank you for joining us. What is your sense, Gautam? Do you think the storm has come and gone? Have we bottomed out for 2018 or the worst is yet to come?
No, I don't think it's a continuing storm, Nikunj. Definitely, there is no end of the storm yet. See, it's very difficult to say whether we'll see very meaningful downside from here. I'll come to the reasons. My basic premise is this year is going to be volatile, driven by global factors, driven by the fact that bond yields globally are going up, and we have been discussing this again and again. Especially the US Fed rate hikes would be material, are material already, and globally, the monetary supply will start contracting from the developed world finally this year, and that is an event that we have to really be careful about, right? Because the entire P de-rating which had happened over the last 5 years has in global markets and equities has been driven by very easy monetary policy and interest rates coming down globally. So if both of these things reverse, then the reverse should happen, P should contract. So that is a given. Now why I say that Indian markets might not correct hugely is simply because of two factors. One is next year is likely to be a year of earnings recovery. I know this story has been so often repeated that people are very, very exhausted with it. Even last quarter was a bit of a disappointment. But we are finally seeing light at the end of the tunnel there, and I think that next year earnings growth should be at least in the mid-teens, if not higher. That's first reason. The second reason is the strength of domestic flows. The financialization of savings and that financialization coming into equity markets through mutual funds, that theme continues to be very strong. So we have liquidity support, we have earnings support. The only factor against markets right now is PE de-rating. So the interplay of these three factors will determine the course of how this year pans out. The real risk is global meltdown, global sell-off, which could really lead to a material correction. Volatility is given. There is a chance that there could be material correction, and even in a good case, will probably not make any returns on the market level this year.
But when you say that you are reasonably confident of an earnings recovery, where do you think the earnings recovery would kick in? Because with the exception of roads, I don't think there is any large sector where the high frequency data is indicating that either capacity utilization or demand resurgence will happen.
So you're right, it is not so much led by demand resurgence. It is more led by beaten down earnings of, let's say, these PSU banks and corporate banks, especially the below PPOP, below operating profit level, where they were booking a lot of provisioning, which will come down or reverse to in certain cases. So that will be, in my mind, the biggest driver of earnings resurgence. And mind you, if you look at earnings in Q3 ex of PSU banks, we had seen a decent growth. Now talking about demand resurgence, we are seeing increased pockets of demand growth. Let's say cement, which is finally seeing some good traction, volume traction. Price has not yet come, but we are seeing volume traction in cement. We are seeing extremely strong volume traction in CVs. So earlier hypothesis was there was a pre-buying till December, but we are seeing that happening even in Jan and Feb. Right? Then we are seeing good consumption of petroleum products, both retail and industrial. We are seeing good freight traffic, import as well as railways freight traffic growth. We are seeing, of course, on the services side, the numbers continue to look robust, be it financial services, retail banks and all, or be it let's say tourism and all that. So I think there is a more broad-based recovery today in high-frequency data than it was, let's say, 1 year back. In fact, I think there is cause to be more optimistic about the demand resurgence. But mind you, it's a very creeping, gradual kind of improvement in the demand scenario. So it's not a V-shaped recovery. That's why I think market participants are not really feeling it, because we tend to feel it if it's a very sharp kind of a change. This time the change is very gradual, very, very moderated, but sector after sector is coming back into growth mode. In the core sectors, of course, steel and metals are the outliers. That reminds me of the fact that the resurgence in earnings is also driven by global commodity prices moving up. So one of the key factors to watch out in in the coming fiscal would again be whether commodity prices continue to rally from here, be it crude prices, be it metal prices. So that is also a big determinant of how earnings shape up from here and how the recovery story also pans out. Because what we have seen is, as steel prices have recovered, that entire sector has recovered. There is huge competitive bidding for the NCLT case in steel. In fact, only the steel NPA, which should be around 2 lakh crore out of the total 9 lakh crore of gross NPA that banks have, looks like for sure it's going to get cleared out over the next few months. So steel has seen a very good resurgence, and I think that is going to lead to more sectors coming back into growth, more driven by commodity prices, driven by creeping improvement in the demand situation going forward.
Gautam, we were just chatting with some of your other mutual fund peers as well, and they said that not as much the market correction, but definitely post the budget announcing a 10% long-term capital gains tax, they have seen some redemption pressure, or rather people turning a little cautious even towards their SIPs. Has that been your experience as well?
Not really. So we have two big businesses, the PMS business and the mutual fund business. I'm told on the PMS side, because PMSs are, the structure is such that the stocks are owned by the investors and are subject to LTCG if the fund manager chooses to book profits within a year, or even if he is booking after a year, so in the new regime. So PMS side, we have seen reduced flows, but net flows are robust. Mutual fund flows actually continue to be robust, might have increased actually month on month in February, and overall we are clipping at a same rate that we are till Jan. So we have not seen much impact on flows so far because of LTCG or because of the correction in the markets, which is a healthy sign. But you have to remember that the first fall is always bought into. So we cannot be 100% sure whether this will sustain, but the sheer size of flows that the industry is seeing, and the size of the SIP book makes us all the more sanguine that even if flows become half from here, even then that's a very decent, very strong number. And mind you, there's a lot of money which is sitting, which is already flown into mutual funds, but is sitting as cash. People are holding on cash, or there is this new breed called dynamic funds, where a lot of money is lying idle, waiting for the right market level to get invested into equity. So there's a lot of latent buying that is there, which will happen if the market corrects. So that's the liquidity positive thing that I was talking about. Liquidity still continues to be very positive for the market.
So where else have you been a buyer besides the pockets that you already talked about, wherein you do find that combination of right valuations given the recent fall and also growth visibility?
Well, retail financials stand out in my mind. The market share shift from PSU and even some of these so-called corporate banks to retail-oriented banks will only accelerate going forward. So that's a theme that I have become much more bullish on the last 1 month. I think that the last 6 odd months of correction in these names lend to a next leg of rally in this segment, and that would include some of the quality NBFCs. I think that is the standout positive in my mind. From a growth perspective, valuations are still slightly expensive, but they're not so expensive that the growth will not be able to compensate for high valuations. The other sector is something that you guys were discussing earlier. That's the OMC pack. If you look at valuations of OMCs, I mean, it continues to be ridiculously cheap compared to the rest of the market. And it looks like, they have NPAs. Like if you compare with PSU banks, which are also, supposed to be very cheap, they have serious NPA problems, now structural problems too. But these are, OMCs are robust businesses, probably the best you can get in the entire PSU set. And we have seen PSUs across the spectrum, and still, and they are hugely moated, right? They are practically a monopoly on the marketing side, and still they trade at single digit PEs. So the outlier value is actually the OMCs in this market, the real value. There are always a lot of value traps, so let's just ignore them. I think the other incremental areas where one should start looking at would be IT, given that growth was earlier falling, and no one knew where the bottom was. But now we're seeing very strong and clear signs that the bottom has happened and there is a gradual recovery. Valuations are also supportive there. Valuations are cheaper than the broader market. Nifty trades at 22 trailing. And I think the frontline IT stocks, the large cap IT stocks are at least cheaper than that. And over a 3-year period, they might actually give as much earnings growth as the broader index does. So, especially in a volatile market, high quality names, large cap names in IT with a global franchise, very, very moated businesses, these are businesses that should definitely come back in the radar of investors today.
I can understand OMCs is a value buy, but why IT? The IT sector is now trading at P multiples which are capturing in a double-digit growth, and I don't think for FY19 we can be sure that the double-digit growth for IT sector is coming. So buying IT now after the recent run-up, some would say that is it a good idea, because 6 months ago, 3 months ago IT stocks were cheap, but that proposition may be missing now.
Yeah, so they are not, Nikunj, you're right, they're not particularly cheap today. But the construct of a possible double-digit earnings growth, in my mind, remains strong. Although they have disappointed, but in the past, but we have seen clear signs of optimism in management commentary. And the other thing is that if you look at where the problem area has been in terms of growth, really, for some of these frontline names is US banks. And when you talk to people who look after IT in these banks, they have a lot of latent demand in terms of IT capex, which they have simply not done since Lehman times. Why? Because of the pressure on profitability, and sometimes also because the IT budget was getting more and more skewed towards digital. But systems need to be upgraded. There need to be major system upgrades, overhauls in US banks, large US banks. The second thing is the tax cuts that Trump is giving will really give them that financial power to start investing in IT capex. So it is a matter of time when it happens. The other aspect, of course, is dollar rupee, because if dollar strengthens in a volatile world, then that has a direct impact on earnings of these IT stocks. So from a very overall 360-degree perspective, in a volatile world and in a world where IT demand is coming back, this is a good sector. I'm not saying that this is a multi-bagger opportunity kind of a sector, but this is a good sector incrementally to be in, even now.
Okay, Gautam, appreciate your time and thank you. You could join us. Let's take a break with the news that PSU banks are leading the market rally today. For a change, it's the Bank Nifty which is outperforming, and the Bank Nifty now is up nearly 300 points. So today, not only we are outperforming Asian markets, we are also outperforming global markets. So for the moment, bulls are able to exhibit that they are in a commanding position, will be sustained for the rest of the day. Let's see. But for the moment, it appears that bulls have managed to really build on yesterday's price action.